Here's a quick video, full breakdown of the velocity banking and how it all works. How to become your own bank with the HELOC method known as velocity banking. So, the strategy nobody at a traditional bank will explain. There is a strategy called velocity banking that has an entire online community built around it. And almost nobody at a traditional bank is going to explain it to you properly because it works against their interests, not yours. Here's exactly what it is, how the math actually works, and where people can get it wrong. So, what is velocity banking? Here's the core mechanic. Instead of your paycheck sitting in a checking account earning nothing, you run your income straight through a HELOC. That drops the balance the moment you get paid. And since interest is calculated on the average daily balance, every day that balance sits lower, you pay less interest. Then you draw back to cover your expenses. So income lands in a HELOC, your paycheck pushes the balance down immediately, average daily balance, and then we're looking at the average daily balance. So every day at a lower balance means less interest accrued, and you draw for expenses. So pull from the HELOC to cover costs, debt payoff as needed. Very great for debt consolidation and incredibly powerful as a revolving line to expand investment portfolios, invest into business, you name it. So why this actually moves the needle? The example, you get paid $6,000. It sits in the HELOC for 2 weeks before you need it for expenses. During those 2 weeks, your balance is $6,000 lower, and every single day counts toward the average. So the compounding effect is, do this every pay cycle and you're not making one extra payment a year, you're constantly suppressing the balance interest gets calculated on. Over months, that compounds into real savings compared to a normal payoff schedule. So here's the common mistakes, what people get wrong about the method. A lot of online chatter oversells this. Velocity banking is not a magic bullet. It works because you have a gap between what comes in and what goes out. That gap is what does the actual work. So it's not free money. It requires your income to genuinely exceed your expenses. Living paycheck to paycheck means no new cash flow is created. The variable rate. So the HELOC rate is tied to prime and moves with the market, typically 7 to 8% at the moment. And this is not a locked 0% strategy or free money, as I said. Discipline is required. Running income through it once is not enough. Consistent, repeated cycling is what produces results. Otherwise, you're exposing yourself to that variable rate if you leave it in there maxed out. So what you actually need to make this work. Interest-only HELOC options, great to get started. Typically, they'll give you a year at interest only. Sufficient equity. So most of the home-based HELOCs will give you 80% LTV. So you'll be able to get a line that shows the difference between your 80% of what your 80 that gives you a line that is the difference between 80% of what your property is currently valued on Zestimate on Zillow.com and what you've already paid down on your mortgage. Positive cash flow, you'll need to be able to repay what you're using, and consistent discipline. Skip any of these and the strategy falls apart before you even start. The surplus cash flow is the fuel. Without it, there's nothing to cycle through the line. So this is where a gap-funded HELOC fits. So exactly the kind of HELOC velocity bank is built around, and most people do not realize it can sit in an investment property owned through an LLC, not just your primary home. Now, LLC-owned properties are seen as riskier HELOCs, so you'll get a slightly higher rate and require at least a 720 to qualify. So let's look at an example. 150K in available credit line. You've got a 10-year draw period, interest-only payment options typically on that first year during the draw window. And then you've got a 20-year repayment, full repayment period once the draw window closes typically. Your FICO, really this should say 650, 680 even. The higher your FICO, the better, especially for an LLC-owned investment property. You want to be at least at a 700 FICO. Now, become your own bank. The traditional loan would be a one and done, borrow it, pay it off, start approval process from scratch. Every time you need capital, you're paying closing costs and origination fees. The HELOC, on the other hand, is a revolving and permanent. Draw it down, pay it back, draw it again. For debt payoff, a renovation, or funding your next deal, no renegotiating No renegotiating terms with a new lender every time. The same line works for accelerating a mortgage payoff, funding a deal, or covering a gap without ever going back to a lender. So see what this looks like with your numbers. If you want to know whether you have the equity and the cash flow to actually make this work, book a call. We'll look at your numbers honestly and tell you if velocity banking makes sense or if a different tool fits better. So head over to gapfunded.com/apply, link in the bio to book a call and run the numbers. Worst case scenario, you walk away with a game plan and know exactly what steps to take to actually position yourself for this strategy as well. So gap funded, days not weeks, that is velocity banking broken down properly, what it actually is, what it takes to work, why becoming your own bank beats going back to a lender every single time you need capital. I'm Mick Wadley from gapfunded.com. Let's go close something.